delighted to have with me Sarah Akbar, Bill Spindle, and Alan Gelder joining us this morning. We have a survey question up there that we put to our audience this week, bearish, unsurprisingly, if we have a peace agreement between Russia and Ukraine, a big if. Bill, let me go to you. Bill Spindle, independent geopolitics and energy analyst, usually based in the US and back there, I believe, but you've just spent a month in Japan, and so we'll get on to Japan a bit later. But let's talk about Russia first and get your opinion on that geopolitical scenario. The peace talks still ongoing, a few slightly positive headlines coming out over the weekend, but nothing concrete. But, you know, the oil market, yes, reacting a little bit up and down to these headlines. I mean, last week we saw a lot of support from tighter sanctions on Russia for the oil market. How do you see the market sort of reacting to this, and how important is it?
Yeah, I mean, clearly Ukraine and Zelensky are being, slowly squeezed towards some sort of a deal that would be, generally favorable to Russia, I think. And then slowly, clearly, what's driving this is the Trump administration's willingness or eagerness in some ways to move in that direction, which means they're probably going to slowly, lift sanctions, move towards more cooperation with Russia. That seems to be what's kind of behind this. So you're likely to see, quite a bit more oil coming onto the market in its more formal, usual ways. That doesn't mean too much more oil overall, but it does smooth out the pathway for a significant amount of Russia's oil to get back into normal kind of market mode.
Okay, Alan Gelder, SVP Refining, Chemicals and Oil Markets at Wood Mackenzie. Alan, what we have seen recently is already sort of more bearish crude versus more sort of bullish distillates, middle of the barrel, and that has been attributed to holding the market up, if you like, and large cracks, sort of spreads between those two. So oil already, crude oil already pretty bearish. How will, a deal, or as we inch closer to a potential deal, impact the distillate part of the barrel? Obviously quite a lot, right? I mean, Russia's a big part of that.
There's a couple of things driving the distillate market now. Low inventories in Europe, but a lot of it is related to sort of two things that all link to Russia. One is the EU's requirement from the middle of January that any distillates coming into Europe will not be processed from Russian crude. So that's effectively a sanctions aspect. So that's impacting buying behavior in India. We've seen that with recent announcements with Reliance. We've also got sanctions on Lukoil and Rosneft, which are complicating transactions in Europe. So that's supporting European diesel cracks. But also we've got a large amount of capacity that is out in Russia because of Ukrainian drone strikes. So if Ukraine is a willing partner to this peace deal, then arguably you can see the Russian refining infrastructure returning to service, which will provide significantly more distillate volumes, which will ease distillate cracks. So for the distillate side, there's an awful lot hanging around the peace deal, the nature of it, and also whether the Europeans accept it and then change their sanctions regime on Russian energy.
Okay, I mean, it'll be interesting to see how much sway Europe has. To be honest, they seem to be hostage to a lot of US pressure on so many fronts at the moment, economically mostly, I suppose. It's all about where the money and power is. Sarah Akbar, Chairperson, CEO, also of Kuwait, welcome. Great to have you with us. Sarah, where does OPEC sort of sit with all this sort of OPEC plus, with the sort of Russian oil? As we know, it's still flowing. Nothing's changed on that front. But with sort of OPEC's influence on the market, with everyone now focusing on Russia, obviously OPEC's planning something first quarter, it changes stance. Is it the swing influencer still on this market?
Yeah, good morning, Diale. Just to give a perspective on when this peace deal happens, whenever it happens. So the aftermath of this peace deal will take time. So we are not talking about first quarter or even first half of next year. If anything, even if we sign today, it will some time before things kicking. This is one
Yeah.
aspect. The other thing is that, I think Europe lost trust. It's the main thing that they lost with Russia. So going back to the old kind of scheme or arrangements will not happen. Their first mission here is to diversify. So yes, they probably will go back to take some gas from Russia, but I think still they will be aware of the kind of situation they put themselves and lessons learned from this. So the impact genuinely will not be even towards the end of next year, the real impact. Now,
Yeah.
if you talk about psychology, if you take about, traders kind of moving things, yes, but genuinely from a reality or from a realistic point of view, you will not see any impact from any kind of deal that will happen except probably towards the end of next year. Anyhow, so for OPEC, I think OPEC has been seriously, really consistent in whatever they do throughout. And they have, kept their mission in front of them. They want to ensure security of energy for all. That's why they want to make sure that there is enough investment going into the oil and gas all over. And they want to keep the cycles. They would just want people to go through cycles safely and easily and affordably by all countries. That's why I think nothing will change with OPEC Plus. They will continue to manage. Although you remember, 2 months ago, they were thinking they will put back all the spare capacity into the market, and then they retracted because they continuously evaluate and they can work together in managing the flow, the supply, so that they ensure that there is some kind of sustainability in the price so that people can keep investing and there is some kind of foresight on pricing so that people can truly invest in developing human oil. So from the OPEC perspective, I don't think anything will change except that they will closely monitor the market, and if there is a need for them to modify it this way, that way, so it will
Yeah,
continue
continue. I
towards
mean, as they have been doing, really, you could argue, and that flexibility still exists. I mean, the spare capacity issue is there at the moment, with markets sort of on the tight side as we end the year. But Bill, let's talk a bit about Japan, where you've just come from. Let's take advantage of that visit that you had. Tell us what you were doing there. I mean, I don't know if it was all leisure, but give us. I mean, obviously we have a new prime minister there, and we have had some headlines this week on the Japan-China front. I mean, how do you interpret that, having just come back from there? Is that purely US pressure with, between Japan and the US agreeing, if, did Japan do that for the US, if you like, put pressure on China? What's going on there, do you think, in your interpretation?
No, I think it's sort of kind of traditional prickliness between Japan and China in their overall relations. We've seen this new prime minister, Takeuchi, come in. She's quite hawkish. She certainly made some statements that have put her on the map and got
Yeah.
China's attention, to say the least. And so I think, that's a lot of what it's about, which plays into a very long historical kind of, as I say, prickliness between the two countries. What'll happen from here? I think the biggest effect on the markets really was kind of underscoring Japan's overall spending and borrowing to do that spending. Part of it is economic. Japan has started to see inflation for the first time in a long time. That's really affected the population, which was really used to deflation,
Yeah.
if anything. So adjusting to that has been difficult. So you're starting to see things like energy subsidies come in. The LDP is doing that. And then you get this security incident, sort of, which draws attention to, I think, to the hawkishness of Takeuchi and the party and how the LDP is moving to the right. And that too is going to, underscore how much spending they're going to need to do to get what they've said they're going to do, get their defense spending above 2%. So that's really hit the, it's started to hit the bond market, but then you get the BOJ coming in and buying to put a lid on rates. But that just translates the problem into a yen problem, and you've seen sort of historic depreciation of the yen.
Okay, Alan, back to you. Let's talk a bit about China, but on the demand side. I mean, as it closes the year, It's been buying up, obviously, healthy amount of crude for storage. That has continued so far, but is expected to maybe, according to some people we spoke to, slow down now in the last month or two of the year. Of course, everyone's got all eyes on 2026 and what support China might, offer to that. Again, it's switched to petchems, also impacting its diesel production, etc. I mean, I'm not sure if you track that market specifically, but from a sort of global balance perspective, what should we expect from China on the crude and product side in terms of how it might influence markets going forward?
Well, China's always an interesting topic of debate, isn't it? Given the way it's regulated and run. If we look at our demand growth outlook for sort of oil products, we've got demand growth slowing really, something just under 200,000 barrels a day this year, and goes virtually to sort of zero in 2027. Drops into, so we think China is nearing sort of peak oil demand. Gasoline's in decline, diesel is in decline. There's some growth in jet, but it's very much a petrochemical story. Sort of crude runs, we think 2026 will be a little bit higher than 2025. If we're monitoring sort of inventories, we saw large inventory build as we went through the year. The last 2 months ago, the inventory started to drop.
Yeah.
And then given the fact crude prices have dropped, we've seen inventories build again. So the question is the degree to which they'll fill their inventories next year, because we're not expecting much growth in crude runs. We've got some more product exports. So the big uncertainty is how they fill their commercial storage last year, and how much of this oil surplus that we have, that we're all forecasting, ends up in Chinese inventories. That'll have a very big impact on the trajectory of the oil price next year.
Absolutely. I mean, that surplus, coming into play much more if China does slow down its intake. Sarah, back to this region, Iranian crude. I don't know if you have any updates on how that's performing. It's all been quiet on the geopolitical front there, more or less. I mean, from a public perception. Some talk now coming out amongst the analysts saying, oh, we're going to see things maybe fire up with Iran in the new year in terms of geopolitically. The focus might come back on it. So give us your view on, is the Iranian crude still getting to its destination? Has China continued to slow down a little bit because of the US pressure? And also then, what do you see in the new year from a geopolitical risk point of view in the region?
So the Iranian flow did not stop because of any of the reasons, any of the interventions. It continues to flow. And I saw maybe in today's news that they are doing through Indonesia now. So I don't know. I'm not sure about this, but it was in the daily news today. So there are many, many ways to get around and continue to sell, and that's exactly what's happening. And this will continue. But I think the thing that make a difference is the visit that Prince bin Salman made to Washington, and during the discussions with President Trump.
Yes, I want to ask you about
They
that.
said
Yeah.
they were trying to create some kind of mediation between Iran and between the US. So I think that process will start. And I believe, with the influence that the US and the Saudi exert today in the region, I think there might be something happening. And I think even with President Trump trying to create peace, I think that is something that might come to play. And then if that happens, I think things will really change in this part of the world. Because it's not only their oil flow, their gas relationships, they stopped sending gas to Iraq because of the sanctions, and now Iraq is trying to buy LNG from the market in order to supply the electrical power plants in Iraq. So yeah, few things will change here if those talks do continue and there is enough pressure from the various countries in the region. So these countries that do want to see that kind of peace are basically a whole GCC, and I think Iraq is very keen on that as well. So
Of course. I
yeah,
mean, the GCC clearly wants a good relationship with Iran, as does the region. Of course, there's, a sticking point there, which is called Israel, which is, stirring that up all the time. And again, some people saying there will be an exchange of fire again between Iran and Israel in the new year. That's the expectation of certain analysts. Let's see where that goes. Bill, just sticking with Japan, was there any chit chat about how its nuclear sort of restart of its nuclear program is going? Obviously a lot of them were out of commission. There's been a plan to bring some of those plants back. Where any update you can give us on that from
Yeah,
what
that's
I've heard?
mainly what I've been doing in Japan over this year. I took a tour through and looked at that Kashiwazaki Kariwa nuclear plant that has now basically gotten approval for restart. They were just waiting for the governor of the prefecture to sign off on that, which
Okay.
he is now done. That will please the government, which is very keen on nuclear. The first thing they'll continue to do is try to start some other nuclear plants. There are a few that have been approved for restart. It's a difficult process. It won't go quickly, but it will probably continue to progress. And then, they're even talking about building new plants. That's a long-term project. But that's,
Yeah.
I was there looking at a giant coal plant, Hekinan, which is where kind of their longer-term plans to begin mixing ammonia and hydrogen derivatives in an effort to decarbonize. But that's basically their long-term energy plan at the moment, which is, restart nuclear, build new nuclear plants, including some SMRs they're trying to put together, and then slowly, very slowly, substitute sort of hydrogen derivatives for coal, and ultimately natural gas a long time down the road. And meanwhile, rely on sort of LNG to be the
Yeah.
cushion. So they're very, concerned and keen to build out the global LNG market, because for them, that's really their energy cushion, and they need a global market to sell into in cases like they've been over the last year or so, where their LNG use has declined as nuclear has improved. So that's kind of the longer term plan. There's a lot of skepticism, I think, outside of Japan, whether that will really work overall, but that's it's progressing, and the new government is behind it, even more foursquare than the last one.
Absolutely, yeah, and as you said, the LNG scenario is there as a cushion and continues for the time being. I mean, Alan, let's talk about a bit. I know LNG is not your specialty, but just back to Europe, and just talk a little bit about Europe's refining, security, if you like, in general. I mean, we've seen refining take a bit of a hit in Europe as newer outfits open here in the Middle East, where I am, and of course in China and Asia. Chemicals, petchems being a big part of the new growth in the East. Any update there on is that the plan for Europe still to sort of wind that down and become a bit more of an importer, if you like, and focus on other areas? Any change in heart there as it sort of also, alters its transition commitment and all these, factors that it's playing with from a cost point of view?
I can say you've touched on a real debate here around how Europe, who sort of believes in liberalized free trade, protects industries that are sort of relatively competitively weak against sort of the new machines, the new bigger, larger, more competitive assets that are in the Middle East and Asia, given the impact of security of supply. You've seen the direction of travel direction hasn't changed. Perhaps the pace has, because we're seeing a realization in Europe that without some sort of protection or support, these industries will likely exit, leave, or significantly lower investment. And what that is causing is some of the politicians to rethink their commitment and the pace around the energy transition aspects. COP30 showed Europe still wants to lead that world, but Europe, its protection means for its industry in that environment, which is like carbon border adjustment, that was received badly by a number of countries in the global south. So there's an element of rethinking that's necessary. Europe doesn't change things very quickly. For the refining industry in Europe, we think actually they're okay for the next couple of years because global oil demand rises. There's not so even though European demand is falling, there's an export market they can target. It's the chemical sector that's really, really challenged because the economies are weak. There's huge amounts of overcapacity, and we're seeing rationalisation of standalone facilities in quite significant numbers. And also, you're getting commentary from Jim Ratcliffe in INEOS, which is a major petrochemical producer, to say Europe really, really is in trouble. And so Europe, if I extend the analogy or take the argument too far, has decarbonised through deindustrialising. The Russia-Ukraine war has highlighted that that's probably not a good thing to do. But so the direction hasn't changed. Perhaps the pace is going to slow a little, but that's something that'll become clear over the next year or so around how carbon border adjustment is implemented in some of the forefront industries that we're seeing. So it's a difficult place for refiners and and particularly the petrochemical sector.
Yeah, absolutely. There's our survey question for today. Tighter sanctions on Russian oil exports will trigger steeper discounts and create more brave buyers. Agree or disagree? Some players exiting the market as those prices have come sort of closer together as the general oil price has dropped. But some brave people still playing with Russian oil and getting it where it needs to go. So agree or disagree. We'll see what that gives us. Sarah, let's take advantage of having you with us and get an update from you on the Kuwaiti energy sector. You know, any progress? I mean, it's ticking along nicely, but I mean, in terms of parliamentary decisions for more investment, and how that sort of its strategy fits in KPC strategy within, you know, what the other main sort of OPEC players might be doing in terms of, market capacity.
Yeah. So in Kuwait, there are a few things that are actually changing. The first thing is that there is a whole series of nice discoveries in the offshore. So the offshore, for a long time, we haven't done any exploration work, and recently, over the last 3-4 years, started that work. As a result, we have 3 big fields now. 2 of them are oil, and 1 is oil, gas, and condensate. So there will be a big effort to develop the offshore. And the thinking is that, well, we have never done offshore operations as such. So the idea here is that we will actually open the industry for international companies to come and assist with that development. I think, they've been working for some time now to develop the economic models and the fiscal structure that they need in order for them to start inviting international companies. I think that process will start sometime early in the next year. So there will be real change in the overall industry in Kuwait, where you have international companies coming to develop some of these offshore and some of the onshore oil fields, especially the deeper fields that have been discovered in North Kuwait as well, and probably some exploration as well. So Kuwait is in a different route now. I think we have suffered over the last few years from an inability to increase capacity. So our share in OPEC is about 2.6, and we almost have only 2.6. We have no surplus. And in the same time, you have fields that are capable of producing even double that amount. So it is all issue about development and field management and all, but I think that trend is going to change early in next year, and you will see a complete different type of industry that will emerge in Kuwait.
Okay, well, we'll keep an eye on that. Bill, back to the US. Let's talk a bit about non-OPEC oil. The US industry. Again, pretty steady as she goes this year. It's hit 13.5 million barrels a day. With relatively low oil prices. What's the outlook for next year if we continue? And most people are saying we're going to have a $60 average price next year. really.
Yeah, I think it's going to be slow going. I doubt you're going to see the kind of increases you've seen over the last couple of years. But I do think, particularly in the Permian and the best parts of the Permian, you're going to continue to see production, maybe even growing production in some parts of it. But overall, it's going to be a real struggle, I think, for the U.S. industry to pull out, well, really to keep production even steady, given prices where they are.
Okay, and I mean, are the private companies there sort of happy with where Trump is directing prices to be at the end of the day, international oil prices? I mean, I'd obviously like them to be a bit higher, so their margin could be a bit more attractive. But at these levels, it's still economical, right? I mean, although they may be focusing on shareholder returns, etc. But can the industry sort of survive, if you like, at these prices long term?
I think it can certainly survive, but there is considerable frustration, I think, in the oil patch as they kind of try to eke out, continue to find ways to keep production up. Just the decline rates are so quick with this fracking technology that it is really always a struggle. You're always racing against the current, and that struggle is just gonna continue.
Bill, I mean, just sticking with you, let's get an update also from you on the U.S. tariff negotiations with everybody. I mean,
which aspect of it?
Yeah,
yes.
just very general. Yeah. But I mean, obviously, the China one is a big one, and China was standing its ground, and Trump is due to visit now China apparently in the spring. I mean, that's a long way away, and relatively speaking, isn't it? By then we'll be in the deep heart of midterm campaigning, etc. But do you see the whole U.S. tariff, I suppose, strategy changing in any way next year, given we're going into midterms and the rest of the world is fed up and getting tired, of this back and forth?
Well, I'm not sure the confusion and mind changing and switching around is gonna improve much. I do think the dynamic that will change as we get into an election year, and it's already started to change, is that this tariff program is running smash, headlong into a giant wave of concern about cost of living. So you've already seen the Trump administration reverse itself on a number of the tariffs that it had already put in place, and then claim we're fighting, to keep your cost of living down, when of course it was their tariffs that pushed that cost of living up in the first place. So I think you're going to see a lot more of that, targeted ways at first, and maybe then wholesale ways to try to bring down the cost of living, or at least appear to be trying to bring down the cost of living, because that's shaping up into the single largest issue. We had these kind of midterm elections, off-year elections a couple of weeks ago, and the Republicans just got clobbered over this.
Yeah.
Absolutely clobbered, and energy prices were right at the core of it. You saw some elections over,
and then the Democrats gave in on the government shutdown, and basically let the Republicans have their way.
Congratulations, you've now fully responsible for a giant cost of living increase on insurance prices. So yes, the Democrats caved, but I'm sure there are many, many Republicans in swing districts that are looking at the prize and saying, how do I get out from under this? Because this is really a huge issue, and it's damaging them badly. So that will mean a lot of shifting around on tariffs, on cost of living. But if you're at the other end of those tariffs, I guess it's good that some of them are dropping. If you like certainty, though, I'm not sure you're heading into any more certain environment.
Okay. Alan, just to finish up for us, Europe, we have a headline: Europe gas prices hit lowest since May 2024. I'm not sure how significant that is, but we are going into winter. Europe has now got cold temperatures. The UK, I believe, is freezing, and a couple of other countries feeling that. I mean, talking about cost of living, that was a huge issue, obviously, wasn't it, post-COVID and in general, and then peaking gas prices with the Russia-Ukraine war a few years ago. But Europe's very settled now, isn't it? It's feeling a bit more secure about that.
Yeah, it's feeling a bit more secure, and our outlook is this wave of US LNG that's coming on as it comes through next year, just helps push prices down. So unless there's some further disruption, well, the global market is going to help Europe secure lower gas prices and ultimately probably eliminate Russian LNG import, Russian gas imports in entirety. So the market is helping Europe in those current aspirations, but we'll have to see where these peace negotiations go, isn't it?
Plenty of US LNG on offer. I mean, Sarah mentioned earlier that Europe might, if there's peace, might go back to taking more Russian oil, but they've also vowed to stop in 2027 completely, haven't they? So let's see which part of that argument wins. Thank you so much, Alan and Bill, and to Sarah this morning. Have a great week ahead. All the best.
Enjoy the rest of your day, guys. Thank you.
Thanks.
Bye.
Bye.